The month of March was a very successful trading month, and in this video, I want to break down the ins and outs of this one specific setup and this one specific strategy that I used this month. That it seems like the patterns were very repeatable, and I kept seeing the setups pretty much on a daily, weekly basis. And I want to break down the strategy, the ins and outs of it, because it has to do with price action and volume. And then I'm going to show you some of the trades so you can get a better visual of this strategy and the system so you can implement it into your own trading. Now, pulling up my calendar, I had a gross profit of $141,000, a 44% win rate, and a 4-to-1 average win to loss ratio on all my trades this month of March. So the first part to the strategy could be looked as an optional step, but I put this first because the more information the market provides us and the more structure it presents, then the more effective this strategy will be. So point number one to this strategy is just essentially looking for the market to rally off of a level of demand or a level of support, and then or sell off from a level of resistance or a level of supply. For example, let's go over the first setup, which was on Monday, March 31st. It was a $21,000 profit and about a 5.5-to-1 risk to reward ratio, trading 20 ES full-size contracts. So pulling up this setup to validate point number one, we're first looking to establish a level of support, demand, resistance, or supply. In this example, the market, specifically the S&P 500, had a level of demand here at 55.53 all the way down to 55.33, about a 20-point range. Now the market revisited this level, bounced off this level as we opened up, sold off into it, held as support, and then the market kind of formed this V-shaped reversal and rallied to the upside. Now this is significant because this is going to point me to step number two of this equation. And step number two is just simply identifying buying or selling volume. In this example, we're talking about the market bouncing off of demand. So obviously we want to identify buying volume. And this could be in the form of a delta outlier, a rebid reoffer, large passive buyer or seller, or some type of absorption. And pulling up this chart on the buying and selling volume, when the market rallied up, we could see there was significantly more green buying or upticks on the time and sales. And if I were to show you what the volume prints look like, we would see as the market's moving up here, a lot of green bubbles, which just indicates a lot of aggressive market buy orders stepping into the market. And this validates point number two. Point number three is essential to this strategy because I'm looking for ranges or areas where the market did not transact much volume at, and we can label this as low volume by price. And this can be done off of a volume profile. So similarly, here's all of the green aggressive market buying coming in, which is just denoted by all these large green bubbles. And now I'm looking for areas where the market did not spend much time at or did not transact much volume, leaving on the profile these areas of low volume. And the first area of low volume that we could see is transacted here around 55.62. 55.60 area, and then one significantly lower around to the 55.50s in this just general area of significantly lower volume. So these are two levels that the market moved up with ease or with larger aggressive volume that the market did not transact or spend much time in this level. So this is safe to say that there's a very large buyer present in this range of low volume. These are best spotted on volume profiles, which could be seen off of a normal volume profile or even a depth of market, which I have on the left side of my charts. We could see where volume is lower, and that's where my cursor's at. And then point number four is just waiting for a pullback in this example or a rally into the range and gauge if those large buyers or sellers that formed that level defend price. And what I like about this is it really cannot be seen much off of a candlestick chart alone. And this is why I always favor the order flow and gauging volume around these levels of interest. So these 4 points here are crucial to the strategy, and 95% of my trades that I've taken this month have to do with this exact setup right here. So let's go over the first trade. Again, a $21,750 profit, a 5-to-1 realized risk to reward ratio, and all this was longing a pullback into a level where buyers were once active and then taking profits above a high a day, which was the target. Now for this trade to make sense, let's go over the levels and the context. I post pre-market plans every single day in the Discord community of the setups that I'm watching and scenarios that I'm looking out for. And the pre-market plan on March 31st was as long as the market can remain supported above this 55, 53, 55.33 level of demand, I am favoring an upside move and a rally to the upside. This was my bullish or bearish line here. Now, what this looks like on the chart is the market pulls back, again holds this level of support, and this is the rally that the market forms. Now, a lot of my trades recently have not been just simply longing or selling at a supply or demand zone. It's using this strategy to put me in the position with higher probability or higher quality buyers or sellers. So as the market was moving up, I formed this level around 55.63, which I've now highlighted by this level of green rectangle of demand, that if the market could pull back into this, this would be an interest level that I'm looking to take a long, targeting 55.80. This is the intraday commentary tab. This is just where I update my thoughts and new things that develop intraday in real time. So I was watching 55.63 and then 55.50. Again, both of those levels are levels of low volume that formed off the profile after the market had bounced off of this level of demand. Now the market's going to pull back into this. And as we pull back, the volume starts decreasing and there is massive absorption at this level of interest. Now at this point, the market pulls back into this range. I get long at 55.61, going for a 19-point target off of 4 points worth of risk. Simply just going for a high day breakout above 55.80, that was my target. It was just simply the market to revisit the high of day. And the reason why I got long on this setup was the market's gonna pull back into this range. And again, here you could still see that area of low volume. In fact, I'm gonna mark this out as a rectangle at the 55.63s where this level of low volume formed. And playing this replay, the market's going to pull back into this range pretty much perfectly. And as we pull back into this white rectangle now, the market is going to form absorption. Now, the way I view this is we're fine buyers at this level of demand. The market rallied, which indicates buyers are there. We are now forming this level of low volume, which just simply indicates even more buyers are there. And now we're pulling back. And as we're pulling back, look at the selling volume as the market comes into this range. As the market's pulling back into this level of interest, we are seeing continuous moves down with a lot of red bubbles, which indicates a lot of aggressive selling, whereas bids down here, this orange and yellow line, are getting filled. So I viewed this as a potential buyer active in the market despite the market not moving down with this selling pressure. And at this moment, this is where I was comfortable at 10.25 getting long for 4 points worth of risk and a 19-point target. And looking at the chart, this lower volume just indicates that somebody is passively buying this, and the market moved up, rallied up to high a day, and this trade was about 10 minutes in duration, and I got all out as the high a day broke for a $21,000 profit, and it's just simply following these 4 steps right here with this strategy. Context, location, and confirmation. If you've all been following me for some time now, you all know the CLC rule. All right, the next setup now I want to show you all was on March 18th, and this was the same concepts, just now to the downside or playing short. This was a $17,000 profit, 20 ES contracts, and this was about a 3-to-1 risk to reward. And if we were to look at this chart, the market had rejected this level of supply on this previous session and began selling off and putting in lower highs, continuously rejecting this level of supply. Now the market's going to open up and we're going to begin to sell off. And I have this level marked here at 56.94 because I'm going to show you why this formed based off the low volume. And what I did here was the market pops into this 56.94, 95 level and fails, where I find enough confirmation to short the market, targeting a lower day breakdown into a level of support, which is this green line. So after this rejection of that supply level, I'm going to just now fast forward and show you all what the tape looks like starting 9:34 all the way to around 9:43, about a 10-minute period when this level developed. Now, what we're going to see on this replay is as the market is selling off, specifically around 5,700, 57.95, and 57.90, we are going to see a lot of negative delta at one and multiple specific prices. So we see the first one here, 56.97, of a minus 11.11 negative delta, which means there is negative over 1,000 more sell aggressive orders than there are market buy orders at this specific price. Fast forwarding, we see another one here form at 56.94, and then we're going to see another one form here at 56.90. Now, what this looks like on the heat map is just denoted by large red bubbles, and the market's going to continuously sell off and continuously move lower. And now we have a couple major points here that we can go back to this original move. Number one is we see a rejection of the supply level that I just showed you all in the pre-market. Number two is we've identified selling volume, which is just delta outliers. We're seeing the outliers in delta of strong aggressive sellers coming in as the market's selling off. And now my job is to find the range where price did not transact much volume by those specific prices. So pulling up the intraday commentary here, the intraday game plan was to watch for a rally into 56.95 to 57.03 to gauge what price does here. We're seeing the rejection, we're seeing the strong delta outliers, and now we form a low volume area around 56.95, 57.03 that if sellers appear, I will look to play shorts targeting that 56.78 level that I just showed you all of that green line. Now, where this formed from was, again, here's those delta outliers. And if we were to look at the volume profile, this range at 56.95 starts this level of low volume, and it goes all the way up to about 57.02. This area was the area of low volume. And if we were just to extend this to the chart, this is where those large red bubbles were of those large delta outliers. So my main objective was to watch for a pop-up into this. If the pop-up fails, I will look to short it, targeting a breakdown all the way into the 56.78 was the target. Well, the market pops up into this 56.95 level. I find enough confirmation to short the market here. One of my confirmations is if the market doesn't spend much time or it immediately reacts or rejects it, which we're going to see right here. Watch as it comes up to 56.95. We're going to see pretty much an immediate reaction, and you're going to see this orange line fill, which just means an offer is sitting there and a seller is present. It happened so fast. It was very quick. It was just a pop-up into this 56.95 level. An offer is there. An offer is a passive seller. Similar to the buying example that I showed you all earlier, this is just now flipped where a passive seller is active. And the market dumped from there, and this was just a very quick profit in 2 minutes time, making a $17,000 profit. I will argue the risk to reward wasn't as high as my normal trades are, but in 2 minutes for the market to sell off like this by spotting these large selling activity, it's just part of the strategy and part of the plan. It's just repeating the same thing over and over again. And the next trade is the same exact thing. The market had sold off into this level of demand. We consolidated for a while. As I mentioned earlier, I really haven't taken many setups just because the market hits a supply or demand zone in these conditions. Ever since like election day or Trump has been in office with the volatility, there hasn't been many setups that I just strictly trade off of, let's just say, a supply or demand zone with the confirmation. I'm looking for this strategy to occur because, again, I'm putting myself in the position that I'm really validating buyers are present. So this was a $15,000 profit, a 4-to-1 risk to reward ratio. The market had sold off into this level of demand. Validating point number one, the market's going to bounce and we're going to see some passive buyers active, which I'm going to show you, which validates point number two. And I'm also going to show you point number three, which is the range of low volume, which I then look to take a pullback down. So the level of demand was at 56.67. The market came kind of deep into this range. But if we were to look down here, we would see a lot of passive buyers or a lot of orange, yellow, red lines that the market sold off into, got filled, and then the market rallied up with aggressive buying volume noted by these large green bubbles. Again, a lot of the things that I'm mentioning, I'm just repeating because the same setups are just appearing over and over again. It's just pattern recognition at this point. Now the market puts in a higher low at this level of demand, and we begin to rally. And similarly, look at this small, very tight level of low volume that formed here around 56.67. We could see an area of lower volume, 56.67, 56.65-ish in this range. So my game plan on this setup, not only do we have demand at 56.66, now we have this area of lower volume around 56.67. And my game plan was to look to long a dip down into this 56.67 level. If it could hold on a pullback, I'm trying it long, targeting a level of resistance that formed in the pre-market session. So long in a pullback, very small room for invalidation here, and the market pulls back into this. I get long and I take profits into strength as the market's rallying up into this area of low volume that formed from the overnight session. And this was, again, a 4-to-1 risk to reward ratio. Now, a couple things that I do want to mention here is the first trade that I showed you on March 31st. The one trade that I showed you was a $21,000 profit. But what I didn't show you this day was a losing trade that was $3,700. And the point that I'm trying to get here is that losses are going to be inevitable. I could show you losing trades. In fact, my win rate this month was only 44%. I had 12 winners and 15 losing trades and 6 break evens. You will have losing setups. But this day that I had, let's just say, a 50% win rate, 1 win and 1 loss, the win was significantly larger than the losing trade. I could have technically had 5 losing trades with this same dollar amount, yet the 1 winning trade would have put me green on the session if I took 5 losing trades, losing around $3,000, $4,000. So when you keep the risk consistent and you maintain a 2-to-1 better risk to reward ratio, you're putting yourself in the position that you can afford to lose. At the end of the day, we are just risk managers, right? So the whole objective that I want everybody to implement, and if you do this, you will be one step closer to consistency and profitability. It's not about the strategy. The strategy is the easy part. We could form millions of different strategies that are successful. What's important is controlling our emotions and managing our risk properly. You have to put yourself in the position to take a minimum of 2 steps up. What I mean by that is that when we are right, our winning trades are a minimum 2 times greater than our losing setups. The higher the number, the better. My setups are, in this example of the month of March, was 4 steps up. What that tells me is I take 1 step up, 2 steps up, 3 steps up, 4 steps up. Now I'm 4 steps up. If I were to maintain a 4-to-1, 3-to-1, let's just say I take a loss and I get a -1 R following my plan. Well, guess what? I'm still 3 steps up. I take another loss in a row. I'm down two losses in a row. Guess what? I'm still 2 steps up. I take 3 in a row. I'm still green on this account, let's just say, with 3 losing trades in a row. Now, after 3 losses in a row, I take a 2R trade. I'm up 1, up 2. Okay, the next setup I take is a 1R loss. Okay, I just took a loss, not a big deal. Now, the next setup that I take is a 5-to-1R. I just took 5 steps up. And I've only taken 3 winning trades in this example, and I've taken 2 losing trades, which gives me what, a 60% win rate, 40% win rate, and I'm still significantly up, let's just say, on this hypothetical example of the 2 steps up minimum and 1 step down maximum. When you do that, where you have a maximum when you're down or wrong, or you have a losing trade, and a minimum of when you are right, for example, 2 steps up, where your losses are 1x and your wins are 2x, 3x, 4x compared to your losses, this is when you're in the position to win. And this is so crucial because we're not in the position to always be right. And I think my trading is a very good example of that, to maintain emotional fortitude that when we lose, the losses are known, the losses are protected. And when we have the confidence in our system that we know when we win, our risk to reward is more significant than our win rate, this is just going to put us in the right position and in the correct seat in the markets. So if you got any value out of this video, let me know in the comments. If you learned something from it, drop a like on this video. If you're new to my channel, hit that subscribe button, and also check out the links in the description below. But I'm ending it on that note. Peace out.